Welcome to this edition of Investment Insights. Today we have John Hepburn with us. 2021 was another year full of uncertainty for investors in the markets, with Aucklanders spending more than 100 days in lockdown, various restrictions across the rest of New Zealand and globally, and the vaccine rollouts. John, can you give us a roundup of the local and global markets over the final quarter of 2021?
The fourth quarter of 2021 proved to be a relatively strong period across the board for investors, with only Japan, the emerging markets and New Zealand posting negative returns. Despite the rise of the latest COVID variant Omicron, financial markets remain upbeat, with financial indicators showing supportive signs of economic growth and governments appearing reluctant to impose harsh lockdown measures to counter the new variant. New Zealand equities had a turbulent year, which continued into the final quarter. A rally in December of 2.6% was not enough to correct the declines of November and October, leaving the index at a modest 0.2% for the year. Australian equities, on the other hand, had a positive quarter. This positive return was entirely attributable to December, as the index declined in both October and November. Global equities finished the year strongly. This topped off an incredible year for the sector, posting positive returns in 9 out of the 12 months and delivering a 24.2% return for the year. Global bond markets did not fare as well over the quarter as investors weighed up the possibility of interest rate hikes and the corroding effect this would have on their return.
Omicron is the latest strain which has achieved new record highs of over 1 million cases a day. New Zealand recorded its first border-related community case in December. What further impact might this strain, as well as other possible future strains, potentially have on Kiwi investors?
Financial markets have been volatile in recent weeks, with investors unsettled in part by the emergence of the Omicron variant. We don't believe that Omicron by itself will derail the recovery, rather that it will simply be another obstacle in the 2 steps forward, 1 step back reality of living with this virus. The variant currently looks to be much less severe than previous variants, however is much more transmissible. This has caused a large number of supply chain bottlenecks around the world as many workers have been forced to isolate with the virus. This has added to the inflationary pressures we have seen over the past few months as companies have lifted prices for goods. If case numbers do not explode to unmanageable levels in New Zealand, we should see relatively little additional impact on our local economy.
There has been a lot of talk that interest rates and inflation will continue to rise. How does this impact investors and the investment options?
Higher inflation, that is more persistent than first thought, as well as strong recovery from 2022 is pushing us toward a swifter reduction in monetary stimulus from central banks. This will be a major theme in 2022, and the transition away from extremely stimulative monetary policy will likely mean increasing volatility, higher borrowing costs, and more modest returns from many asset classes. In New Zealand, after 18 months at a record low of 0.25%, the official cash rate was moved to 0.75 in early October. Inflation is very high, house price gains are unsustainable, and the economy is running hot against the backdrop of an extremely tight labour market. Financial markets expect the OCR to peak near 3% in the next couple of years. This is likely to impact confidence, spending, and the housing market. The inflation debate is likely to remain heated well into 2022, and while we believe some elements of the current cost pressures will subside, investors mustn't be complacent. We have seen some of the world's central bankers acknowledge that inflationary pressures might be more persistent than they first thought. For investors, the path of inflation and interest rates is a crucial piece of the economic puzzle because of the impact it has on investor sentiment, asset prices, and company margins.
Looking forward into 2022, what are some of the themes you think we can expect to see in the markets?
We expect 2022 will be more difficult for investors to navigate. With world shares almost 25% above pre-COVID levels, the easy gains are behind us. While the tailwind of easy monetary policy is now a headwind as central banks look to reduce stimulus and raise policy interest rates. As an active manager, we will see attractive opportunities and remain comfortable with our investment strategy. However, returns are likely to be more modest, volatility higher, and the divergence between various sectors and companies more pronounced.